If confidence goes to fear, credit markets can deteriorate overnight. With no access to liquidity in society, those people who have access to liquidity will be able to take advantage of the circumstance rather than being taken advantage.
Have you heard the latest buzz in the financial world? It's something so astonishing that it's turning heads and sparking debates across the globe. Gold markets, long considered a bastion of stability, are on the cusp of something extraordinary. We're not just talking about a minor uptick here. No, we're diving into a scenario where gold is poised for a crazy bull run, skyrocketing to a staggering $4,000. Imagine that, gold, the timeless symbol of wealth and security, reaching heights that would rewrite financial textbooks. How is this even possible? What's driving this unprecedented surge? Stay with us as we unravel this golden mystery piece by piece, revealing insights that could redefine your understanding of the market. And remember, this isn't just another market prediction. This is a potential financial revolution. So buckle up and let's embark on this thrilling journey to uncover how gold could reach this unbelievable milestone.
I think now that it's inevitable that precious metals will do well. I say it's inevitable for reasons that you and I have discussed ad nauseum over the last 3 years. Precious metals do well when people are concerned about the purchasing power of their savings denominated in fiat. And anybody who isn't concerned about the maintenance of their purchasing power is both illiterate and innumerate. We've talked about the subdivisions of concern before. Quantitative easing, which is really counterfeiting. Debt and deficits, negative real interest rates, inflation. There are some people who are less concerned about inflation because they follow the CPI, the Consumer Price Index. And I want to disabuse them of that right now. The CPI is not a measure of the depreciation of the purchasing power of your savings. It's a constructed index, constructed by the big thinkers, hedonistically adjusted, which means they decide what an apartment is worth or what a computer's worth. They don't let the market decide. Too inconvenient for them. It doesn't, when it's inconvenient, include food or fuel. Then again, I like to eat. I like to drive. But most importantly, it doesn't include tax. Anybody who shops where I shop and buys the basket of goods and services that I consume will understand that tax is the largest household expense of working American families. And a cost of living that doesn't include government isn't a cost of living. I would submit to your viewers, before I answer the rest of the question, that the basket of goods and services that they consume, including government, willingly or unwillingly, means that their purchasing power is declining at 7% compounded. The anti-gold, if you will, is the U.S. 10-year Treasury, a fiat-denominated savings instrument. So here's the arithmetic. Your government, the U.S. government, promises to pay you, I think it's 4.26%, and they will, every year for 10 years, in a currency where the purchasing power is declining by 7% and probably increasing. In other words, the government absolutely positively guarantees that they'll cost you, 276 basis points, 2.75% of your purchasing power every year for 10 years. The first promise our government has made me that I unequivocally believe that they will deliver. So, with that long introduction, it staggers me that people aren't more willing or more eager to invest in gold or silver. Previous gold bull markets have shown that a relatively small amount of insurance by way of gold or silver can generate large coverage, protecting your portfolio. In the decade of the 70s, the last time that we faced the recipe, the sort of menu of problems that we face today, the gold price went from an admittedly price-controlled $35 all the way to $850. A little bit of gold sheltered a lot of damage to the rest of your portfolio, probably more meaningfully. The last real gold bull market we had, 2000 to 2011, the gold price went from $256, I think, to $1,850. Pretty good move, sevenfold move, maybe more. The point of this is that people who don't have somewhere between 5 and 10% of their portfolio in precious metals are going into a circumstance with absolutely no portfolio insurance, with the need for real portfolio insurance. Beyond owning physical gold and silver, A is liquidity and B is insurance, people need to consider owning the gold and silver mining stocks. I'm going to argue that most people should own 3 or 4 of the great big ones, which is to say buy market beta. Because when the gold stock market moves, the biggest and best companies in the universe can give you 300 or 400% gains with very, very, very little company risk. For people who are willing to do more work and take more risk, absolutely, positively, buy the juniors, a well-constructed group of juniors. I joke, Dunnigan, because all of the money now I invest prudently, I made by speculating wildly. I'm not saying.
As we delve deeper into this golden saga, let's first cast our eyes on the current state of the market. Right now, gold is trading near an impressive $2,070 per troy ounce. But why is this significant? Well, this isn't just a random number. It's a beacon signaling a shift in the market's undercurrents. The US dollar, often seen as the gold market's arch nemesis, is facing its own set of challenges. You see, when the dollar weakens, gold typically shines brighter. And right now, the dollar is grappling with softer economic data emerging from the United States. This is crucial because it suggests a potential dovish stance by the Federal Reserve in its upcoming policy decisions. But wait, there's more. The yields on US bonds, a reflection of investor sentiment, are hinting at something big. These yields are down, indicating a general expectation of lower Federal Reserve policy rates. This is like a double-edged sword for the gold market. On one edge, it boosts investor risk appetite, driving them towards gold. On the other, it means that traditional investments like bonds are losing their luster, again pushing investors towards the safe haven of gold. So what does this all mean for you, the viewer? It means that we are standing at the precipice of a potential gold rush, the likes of which we haven't seen in recent times. Now, I want to ask you, the audience, how do you think these economic indicators will further influence the gold market? Share your thoughts in the comments below, and let's start a conversation on this fascinating topic. But let's not stop there. We must also consider the global perspective. The world is shifting, and these shifts are not just economic, they're geopolitical. The Middle East, a region synonymous with volatility, is yet again in the spotlight. Any development in this region, especially around the strategically crucial Red Sea and the Gibraltar Strait, can have far-reaching implications on the demand for safe haven assets like gold. And there's more. Central banks around the world are quietly but steadily moving away from dollar reliance. This is big news. These institutions are the juggernauts of the financial world, and their actions speak volumes. They're increasingly investing in commodities, particularly gold and silver. This isn't just a fad. It's a strategic move indicating a shift in global financial power dynamics. It's like a chess game, and gold is the queen, becoming more powerful with every move. Remember, all these factors are interconnected, weaving a complex tapestry that is the global financial market. Each thread, each development influences the next, creating a narrative that is both intricate and fascinating. And let's not forget, amidst all this, your role as an informed viewer is crucial. Keeping abreast of these developments, understanding their nuances, and seeing the bigger picture is key to navigating this ever-changing landscape. So, what's next to this gold story? How will these global shifts continue to impact the market? The answers to these questions are not just academic. They could shape the future of financial markets as we know them. Stay tuned as we continue to explore this golden journey, a journey that could lead us to the astonishing prospect of gold hitting $4,000. As we venture further into this golden odyssey, it's crucial to turn our lens towards the intricate tapestry of global financial shifts and how they're intricately woven into the narrative of gold's potential ascent to $4,000. Central banks globally are playing a pivotal role in this narrative. It's a significant shift, a departure from their traditional dollar-centric strategies. These financial behemoths are now increasingly turning their attention to commodities, especially gold and silver. Imagine the impact when these powerful entities which steer the global economy start hoarding gold. It's not just a change, it's a seismic shift in financial strategy. This move is a clear indicator of a new era dawning, an era where the value and security of commodities like gold are placed at the forefront. But why is this happening? Let's unpack this. It's partly due to the growing skepticism towards opaque debt instruments and a rising inclination towards tangible assets. In a world brimming with economic uncertainties and fluctuating currencies, gold stands out as a beacon of stability and trust. And when central banks, the guardians of national economies, begin to accumulate gold, it sends a strong signal to investors everywhere. Now let's shift our focus to the geopolitical chessboard, particularly the BRICS nations: Brazil, Russia, India, China, and South Africa. These countries are not just rich in natural resources, they're becoming increasingly influential in the global financial system. Their actions, their policies, and their alliances are reshaping the world economic order. Their interest in moving away from traditional financial systems and creating alternatives to the dollar-dominated world is not just a statement, it's a strategy. This strategy underscores the growing importance of gold as a cornerstone of financial stability and independence. Furthermore, the geopolitical tensions in the Middle East, particularly around the Red Sea and the Gibraltar Strait, add another layer of complexity to this scenario. The potential closure of these strategic routes could disrupt global trade, leading to increased volatility and uncertainty. In such times, gold's allure as a safe haven asset only intensifies. Investors in their quest for stability are likely to flock towards gold, further fueling its price surge. Let's also consider the insights from financial experts like Rick Rule. These thought leaders provide a deeper understanding of the current state of the precious metals market. Rule's perspectives on investing and speculating in this sector are particularly enlightening. His distinction between the two and his emphasis on the strategic value of maintaining liquidity in both cash and bullion offer valuable guidance for anyone looking to navigate these turbulent financial waters. In light of these factors, the journey of gold to $4,000 seems not just plausible, but increasingly probable. The convergence of these global financial shifts, geopolitical developments, and expert insights paint a compelling picture of a market ripe for a significant bull run. As we continue to explore this unfolding story, remember to stay connected. Subscribe to our channel for more in-depth analysis, insights, and the latest updates on this golden journey. Your engagement, your perspectives, and your voice are what make this journey truly enriching. Let's continue to unravel the mysteries of the financial world together. Stay tuned as we prepare to dive into the final chapter of this saga, where we'll piece together all these elements to form a conclusive picture of how gold could achieve the monumental milestone of $4,000. But first, we'll take a look at what Rick Rule has to say.
The other night, and I was thinking, there are a lot of people out there, Dunnigan, that have an understanding that things aren't right. They can feel it. They can see what's happening here in the country, the divisiveness, the lack of unity, all of the things that we've talked about here, where you're defined by who you vote for, and all of the problems in this country. And people understand that. They feel that. They sense it, even if they can't articulate it. But it kind of dawned on me, seeing as that a lot of what I talk about happens outside the country. And I think the world is changing so much more quickly than most of the people in this country understand. And it's because there's virtually no coverage of the rest of the world in the American media. And so I don't think that the people listening to you have a good sense of it, certainly not just because of me, but all the wonderful guests that you have on, but the people out there just don't have any understanding. One of the things I wanted to touch on real quick, we talked a lot about the United Arab Emirates 2 weeks in a row. The first week we talked about how they said we're not going to take dollars for oil anymore. And then last week we talked about how it's been kind of hard to find that story that MSN brought out on behalf of another site. But I found it interesting, and I don't think we talked about this, but that, the announcement supposedly was made 2 days before 200 countries came to Dubai for the United Nations Summit on Climate Change. Great. So, the gentleman presiding over it is the head of the state-owned United Arab Emirates oil company. They make that announcement 2 days before 200 delegates show up in the country. Big announcement. We agree on that, I believe. But one of the things that happened subsequently that I find very interesting, and I'm not sure if we touched on this or not. If we did, forgive me. If not, maybe for those who haven't heard it, I think it's very interesting, and that is that an impromptu meeting by Putin happened a day or two after the summit ended. And that's relevant to me because, look, you had Putin flanked by 4 Russian MiG fighter jets make an impromptu unannounced meeting to Dubai right after the summit ended, right after they, United Arab Emirates told the world we're not going to take dollars for oil going forward. And then goes directly, and it's a big deal because, look, Putin hasn't left the country more than twice in the last few years because of the American or Western bounty on his head. So, he flies to the UAE right after this announcement, right after the meeting. When you put it in context with Gaddafi and Hussein, who made similar announcements. Is it coincidental or not? And then goes directly from there to Saudi Arabia, where OPEC then announces an increase in their $1.1 million barrel per day reduction to 2 million plus barrels per day reduction. Is it all coincidental, or are all of these things lining up and gaining more and more critical mass, velocity? And I think the answer, at least in my mind, is yes, they are gaining critical mass. And so I just wanted to touch on that in terms of the...
And now we arrive at the apex of our journey, the climactic moment where we piece together the intricate puzzle of the gold market's potential bull run to $4,000. This is where all the threads of our story converge to form a clear, compelling picture. Firstly, let's revisit the core of our narrative, the incredible strengthening of gold prices amidst a backdrop of global economic shifts. Gold, currently trading near $2,070, is not just experiencing a fleeting spike. This is a sustained surge, underpinned by a combination of factors that are reshaping the financial landscape. The role of central banks is paramount here. Their increasing accumulation of gold is a testament to the metal's enduring value and appeal as a safe haven asset. This strategic shift by global financial powerhouses is not a mere trend, but a profound change in their approach to reserves. When central banks start hoarding gold, it's a clear signal to the market about the metal's perceived value in the coming years. This is not just about diversification. It's a strategic move towards what's perceived as a more stable and reliable asset in turbulent times. Geopolitical developments, especially in the BRICS nations and the Middle East, have added fuel to this golden fire. The uncertainty and volatility stemming from these regions have historically driven investors towards the stability of gold. And now, with growing economic clout, nations like Russia, China, and India are not just passive players in the gold market. They are active, influential participants whose actions have significant global repercussions. Moreover, the expert insights we've gathered paint a clear picture. Rick Rule's analysis, for instance, is not just about the current state of the precious metals market. It's about understanding the underlying forces driving this market, forces like the depreciation of fiat currencies and the rising importance of tangible assets like gold in a world riddled with financial uncertainties. All these factors, the strategic moves by central banks, the geopolitical shifts, the expert analyses, converge to create a market environment where gold's surge to $4,000 is not just a possibility, but a scenario grounded in sound logic and robust facts. This is the golden climax of our story, the point where every piece of information we discuss comes together to form a compelling conclusion. Before we wrap up, let me remind you once more to subscribe to our channel for more insightful content like this. Your engagement and your quest for knowledge drive us to delve deeper into these complex topics. And as always, remember, this is not financial or investment advice. It's an exploration of possibilities, a journey through the fascinating world of financial markets. Thank you for joining us on this journey. Stay informed, stay curious, and keep exploring the dynamic and ever-evolving world of finance.